Howdy, Jacob here. Today we're looking at CRA International, maybe CRA International. They're a professional services industry, 1.1 billion enterprise value, slightly less, or 1.1 billion market cap, slightly less enterprise value, incorporated in 1965. They provide economic, financial, and management consulting services worldwide. Growth has been pretty impressive. Only 1 year of declining revenue. Outside of that, revenue has been pretty consistent in the upper single digit range. Gross margin going down, but operating margin going up. Almost double digits now for operating margin, and a 30% gross margin isn't terribly impressive, but not too bad. Dividend per share is not a huge payout in relation to their earnings. We'll see free cash flow, return on invested capital, low double digits, very likely above their weighted average cost of capital, meaning that they are increasing business endeavors, which is great for them. 46 million cash on hand, no short-term debt, no long-term debt. Very positive from a balance sheet perspective, as you don't have any interest-bearing debt outside of capital leases. Capital expenditures have gone down and cash from operations has gone up. So much heavier production of free cash flow, and their use of cash is a little bit on the dividend side, maybe 20% dividend, 80% share repurchases, or at least close to that from a capital allocation standpoint. A tiny bit of acquisitions, maybe 20% dividend, 60% stocks, share purchases, 10-50% acquisition. And so I think we're ready to make our assumptions here. So on the revenue growth side, we have seen some pretty solid revenue growth. I think they can get to 6% fairly reasonably. And as for margins, historically, they're about 6 to 7%. I feel pretty comfortable going in that range, 6 and 7. They do buy back a bit of shares. 1% would be about 10 million. 35 million would be about 3% because you have to include stock-based compensation, assuming that those options fall through or go through when the stocks are issued. So 35 million is something that I think they can manage. And then the dividend, have they increased that in the past? They have increased that pretty substantially. So maybe I'll do increase it 10% a year for the next 7 years. Take this share change down to 2.5%. Because again, obviously you can go into debt to fund these projects, but it doesn't look like they've done that historically, and we don't want them to. So I'm saying I'll change a little bit of capital allocation extra going to dividend and a little bit less to share repurchases, because you only have 100% of capital allocation unless you go into debt. A P, price to free cash flow, for this type of return on invested capital, pretty decent. Historically, not as decent, but recently pretty good. Margins are all right. Growth is pretty decent. I think I can just go roughly market average here. And we're saying the company's stock price needs to fall a little bit more than half to get to the return I'm looking for here. I think it's a fine company. I just don't think it's currently at the price to me that is something I'm going to be jumping in on. But I do hope you enjoy the video, and I do think it's a good company. I just got to be waiting for it to get to the right price for me. Thank you.